Good morning, everyone. It's finally here. The WTI curve went into Contango for the first time several years yesterday. And the good thing, smallest of silver linings, the good thing about the last couple of days, which flipped the curve into Contango, is that there is no doubt about what's behind it all. This is not a supply glut. These are fears over demand. And so what I want to talk about today is to make sure that everybody understands the signal that we're getting and how important and how validated it is, especially since you hear people all the time say, oh, Contango, what's the big deal? It's just a natural state of the crude curve. Nothing could be further from the truth, as we'll see here. So let's get into where we are today. Trade wars 2.2, call them that, started on Friday. That's got the market on edge. But the markets were already in bad position, as you can see. I mean, oil prices have been selling off for a couple of years. And really, oil has been down since the last couple of weeks, been down sharply, even before China's, the tit for tat between the Chinese and the United States. Demand concerns, supply glut concerns. And by the way, this is something that we were worried about last year. The supply gluts, which is really demand thing, came up last summer into the fall. The market started to shift in that direction, and then it kind of went away. Well, it didn't actually go away. The supply glut never went anywhere. What happened was we had the artificial high due to especially tariff distortions, front-loading so much activity that it temporarily raised the demand for oil. And so the supply glut the market was fearing would hit early in 2025 was pushed further into the future. It didn't disappear, it didn't go away, because the economic activity early part of this year was never anything more than artificial. And now it's being paid back. And so not only is the WTI Contango signal a global downturn signal, it's also another confirmation that we are indeed into global payback after the artificial distortions earlier in the year. With the news this morning, geopolitics, oil prices are down again, closer to what would be a multi-year low. Wholesale gasoline prices are already there, revisiting their low from Friday. Not much of a rebound yesterday. When you look at the actual front-end spreads, again, you can see WTI falling from late in September before we got to the trade war stuff, but there isn't any contango at the front of the curve. The curve it's not exactly steep, but it's still in backwardation, as we'll see in just a second. But it's still relatively steep at it's still in backwardation at the front end, the 1 month calendar spread as well as the 3 month calendar spread. Instead, the contango is a little bit further down. So you look at the evolution of the curve over the last couple months, and then yesterday what happened was we had a little bit of backwardation in the front end of the curve. That's the part about the market still in a relatively not oversupplied. I hate the term oversupplied. Not oversupplied just yet, but in the near term, the market is still relatively normal. But the contango showed up yesterday around the February 2026 contract, right on through to December. So the curve shifted into 2026, which is again about not oversupply. It's not about OPEC. It's about fears about where the global economy is heading, which we can see because what is it that changed over the last couple of weeks, or the last couple of days really, that flipped the curve into contango? Well, it was the trade wars, the fears about what that might do to an already weak economy, already weak demand situation. It wasn't an OPEC announcement. If anything, the OPEC announcement from the previous weekend was less bearish for crude oil because it wasn't as big of a production restoration as many people had been fearing. So the contango here is about demand. It's the curve. It's the marketplace saying we're afraid that demand is going to shift even worse than we were expecting before over the next several months. And so that by the time we get to next year, we got to start paying people to put oil into storage because there's going to be too much of it. That's what contango really says. It's when the curve shifts that future prices go up because the market is paying and incentivizing those with oil to put it into storage because there's going to be too much of it floating around in the current marketplace, in the spot market. But because the curve is backwardated at the front and contango in the back, what the market is saying is not quite to that situation yet, but it's no longer just some future possibility or future property. It is actually taking place. The market is actually shifting. There is real money changing hands based on the expectation that the supply glut, which is really about demand, is coming relatively soon. And then today what happened, more geopolitical news, oil prices go down even further. The contango steepens out. Now it's still backwardated at the front end, But I hope you can see a little bit that the contango has shifted from March and February 2026. And now, as of this morning, the January 2026 contract is even with February. So already in the short run, the contango was moving up a little bit closer to the current period. So less backwardation in the front, less room for backwardation in the front, and more contango at the back. And just a day, the contango was increased by about 30 some cents, to the point that the difference between the January and February 2026 contracts and the December 2026 contract is almost $1. And a couple points during the morning, it was actually $1 worth of contango, which already tells you that this is getting serious in a very short run basis. And as I said, because of the circumstances that we find ourselves in the short run, the geopolitics, the concerns about credit markets, concerns about the economy, labor market in the United States, China, what's really happening there, all of it suggesting that this is not some future thing. The markets are really betting, and there's in the contango, the shift on the curve is indeed moving pretty quickly, which is that part is a little bit surprising. And by the way, the contango signal is another one of these hidden truths that we talk about here all the time at Eurodollar University. It doesn't get nearly enough attention across the mainstream because a lot of people don't really know what it is or what it actually means. And those people who do often dismiss it as some kind of natural signal that, the curve goes between backwardation and contango all the time. And again, nothing could be further from the truth. But just to remind you, one last reminder, we are having a webinar tonight, 6 p.m. Eastern time. There's a link in the description to sign up, where we're going to go over some more of these hidden signals, the wealth of information that is available to people. All you need to do is look around and access it. It's there. And stop listening to the mainstream. Stop listening to central bankers who either pump you full of purposeful disinformation, or in many cases, they just get everything backwards too. These are very critical signals. And for WTI Contango, that's what we'll go through here. And then later at the webinar, we're going to go through some interest rate signals and talk about the hidden truths behind those. Like I said, there's a link in the description to sign up. There's still time to do so. That's 6 p.m. Eastern time tonight. Let's get back to Contango, though. I did a video here on YouTube a little while ago. I think it was a little bit over a week ago, where this is Bloomberg's article about the possibility of Contango. They used the Brent spot to the 1-year forward spread. It doesn't really matter, as you'll see here. But what stood out here, and what should stand out to everybody, is when the curve, this pretty long curve, the curve spread, when it goes into contango. Look at the common thread between all of these periods, 2020, 2016, and 2008. These are all periods that are marked by global downturns, including 2016, as we'll see, 2020, of course, global downturns, but also deflationary money, because deflationary money is a critical part of the WTI futures or any futures curve shape to begin with, because you got to borrow money at some point. Everything is finance. And so tight money also plays a role, which is why you see 2008, 2016, and 2020 so prominently with contango. They call it a supply glut to avoid having to admit the truth, that this is about global downturns, which the Fed says never happens, and it's about global deflationary conditions, which the Fed says we print money, or everybody says the Fed says they print money. The Fed actually doesn't say that if you actually listen to what they're saying. But everybody says the Fed prints money, so how can we have deflation? It must be about supply. Now, these are global downturn deflation signals. And let's talk about those. So using just the 3-month calendar spread, what you see is these discrete periods where contango shows up, and they align with global downturns. Contango is not a normal position for the futures curve to take. I'm just taking a couple of examples here. And by the way, I covered this at our deep dive analysis a couple of days ago, in fact, last week. And we even talked about it in our Eurodollar University Substack One Big Weekly Theme, which is that's really a stripped down version of the deep dive analysis. For those who don't want to go full into the deep dive, you can check that out at Substack. But 2016, a perfect example. Most people didn't even realize that the U.S. economy was in a downturn, or that the global economy as a whole was in a very serious downturn, especially emerging markets that got hammered. But there was a very serious slowdown in the United States. This is one reason why I say this. These hidden signals is because, as the New York Times admitted a couple years later in 2018, they went back and said, oh yeah, by the way, there was a really serious slowdown in 2016 that basically looked like a recession in every aspect except for labor market job losses. And this is, by the way, a big reason why Donald Trump became president in 2016, because he pointed out the lack of recovery and the And it occurred, the election in 2016 occurred at the tail end of what the New York Times called in 2018, the invisible recession of 2016. But to my point about these hidden signals that shouldn't be hidden, it was not invisible. It's right there in the oil market. The oil market flipped into Contango, which was, again, a global downturn and a global deflation signal that everybody dismissed as nothing more than a supply glut based on the shale revolution. Well, the shale revolution was known ahead of time. Everybody knew that this oil supply was coming online. What changed, what flipped the curve, was the sudden and unexpected by most of the marketplace, or that parts of the marketplace, the unexpected shift in demand. So it wasn't an invisible recession of 2016. There was a very visible reason why Janet Yellen only hiked rates one time in December 2015 and then waited an entire year to December 2016 to start hiking again. Because there was this, what everyone says, or the people who know it, say was an invisible recession, which was not invisible. It was right there in the marketplace. It was in the Contango signal. And it was in a whole bunch more beside, which we'll talk about here tonight on the webinar. Another case, the more recent case for Contango, 2023, 2024. Actually started in 2022. Everybody missed that one too because pretty obvious reason. First of all, everybody was talking about inflation. Everybody's talking about oil supply shock. So how can there possibly be Contango and oversupply in oil, especially after OPEC reduced production late in 2022? But when you start putting these pieces together and putting them in order, you realize that OPEC was pulling back supply because demand wasn't there. That's why you saw Contango develop in late 2023, or late 2022, into early 2023. And the other part of that was not just the demand flip to forgot how to grow. So we were on the downside of supply shock to begin with, but let's not forget, between September 2022 and March and April 2023, and this is gonna come up a lot in our webinar tonight, between those two periods in time, deflationary monetary conditions. So you have Contango show up right in that window, September 2022, transition to forgot how to grow in the economy, plus deflation that led to the banking crisis in early 2023. So the Contango that everybody dismissed in late 2022 was another powerful signal about the transition of the global economy and the monetary system. There is one other case that I do want to point out, and that is 2004, 2005, 2006, and into 2007. This is the one time where we see lots of Contango on the crude curve, but it doesn't fit with a global downturn or deflationary conditions. But that's not what we're seeing here. As you can see, first of all, oil prices were rising and rising sharply, and the Contango was only at the front end part of the curve. It wasn't the entire curve into Contango. There's lots of backwardation around the rest of the curve. What that suggested was, and what that indicated was, that market participants were pricing what, if you're old enough to remember like me 20 years ago, what everybody called peak oil. And peak oil was simply that the Middle East was not able to add additional supplies to the marketplace like they had been. You know, Saudi Arabia in particular had been the marginal source of marginal supply as well as restriction in supply for decades before then, trying to maintain a relatively stable price in oil. Well, the Middle East was no longer able, with the rise in demand, especially in China and around the emerging markets, too much demand, not enough supply. If you remember, U.S. supply had been dwindling for decades before we got to the shale resolution. Basically, it was a supply squeeze, and the reason why the futures curve went into Contango rather than a global downturn was that there was a huge incentive and a huge demand, really demand side, to put oil into storage as sort of an emergency, you know, in private sources of private petroleum reserves around the world, because there was no marginal supply. And a lot of commercial participants were worried that if something did happen, like, you know, Hurricane Katrina, that it might knock out supply and therefore become a huge problem. So the Contango in 2004, 5, and 6 was a special case. And it's the only one, the outlier, the exception that proves the rule, where Contango is otherwise associated with global downturns and deflationary monetary conditions. That's the only time over the last 30 years where you see Contango not associated with a major global downturn and deflationary monetary conditions. So this Contango signal that we're getting here in 2025, even though it was supposed to happen last year in 2024, the artificial high delayed it. Here it is in late 2025, and it is a bright, shining, flashing global warning sign. And as I said, there's a couple different factors that go into it. Everybody knows supply. The mainstream always focuses on the supply angle. And yes, there is additional supply coming from OPEC and other sources, but that's not really the problem here. The issue is demand, as we're seeing more recently, as I said, the last couple of days with the geopolitics. But we also have to keep in mind financing. That's the third major fundamental factor that goes into especially commodity futures and especially oil futures, because we're talking about big dollars that need to be financed and big positions that need to be financed. So when we see Contango develop on the WTI futures curve, that's one. It's alarm about demand and what the market is perceiving about demand. No question about that. But also we have to keep in mind that it could be also related to deflationary conditions that are developing in the monetary system, which, by the way, is exactly what we've been talking about over the last several months, really going back to the July payroll report, which came out in early August. As you can see with one of our deflationary signals on the Federal Reserve Bank of New York's custody of foreign reserve assets, specifically U.S. Treasuries, and how they tend to disappear during deflationary conditions. Well, they have disappeared and then some over the last couple of months, which suggests in some ways that the contango that's developing on the futures curve, especially as fast as it has in the short run, might also be related to tightening monetary conditions that we have been talking about and observing. The rising U.S. dollar exchange value, sell America, the tightening that's going on in the Eurodollar system that also fits with what we're seeing in contango here. So it's another warning sign of something we need to keep in mind, which is, of course, consistent with what we're seeing in the U.S. Treasury market, Treasury rejection and sell America. Yeah. I mean, you can see on the chart that first of all, the yield curve is steepening, and then overall it's bull steepening because short-term rates are going down faster than long-term rates, but the entire curve is going lower, and that includes the last couple of days. The 2-year Treasury as of this morning is back down to 349, which is very close to where it was in the early part of September. I think it's pretty likely it's going to take out a new low, and if it goes a little bit further, you'll get to a multi-year low. Same with the 10-year Treasury, can go back down to September. But by the way, my point is that just the yield curve and the changes in the yield curve go along with a market in the oil market and oil futures that suggest, first of all, a demand problem developing. That's the bull steepening in the yield curve, as well as the monetary problems that might be going along with it. Consistency around all of these signals, and then some. So let's finish up here by asking the question, what should we expect out of, first of all, the WTI futures curve, and then maybe more broadly than that? Well, for the futures curve, well, number one, I'm a little bit surprised at how fast the contango has developed and how fast it's moved. But we shouldn't be surprised if the contango kind of moves back and forth. If you remember with Eurodollar futures and other curve inversions, including the yield curve inversion, it doesn't stick right away. You get the first initial warning that, okay, the curve is upside down, it's upset, it's distorted, and then it kind of disappears, and it comes back, and it disappears, and it kind of goes back and forth a little bit over the short run, maybe even the intermediate term, before it finally sticks and broadens out and steepens. I would not be surprised if we see the same thing here with WTI futures, where it flips into contango, even as much as $1 in contango between January 2026 and December, and then maybe it flattens out again, maybe even goes out of contango into a little bit of backwardation, but stays relatively flat, maybe back and forth over the next little while. That would be consistent with how markets, especially futures markets, behave in the short run. But over time, as the economy continues to fall off, assuming that it does, and everything is priced that it will, as the global economy continues to fall off, that back and forth would kind of disappear, and the curve starts to steepen out more and more and more into contango. And then the backwardation that's still at the front of the curve will eventually disappear, and the entire curve will be in contango. And when we see that, that's the next major signal that we're looking for, because that's more of a timing signal as well. And then we're going to look at how steep the contango will be after we get to that point, because that will tell us something about, again, monetary conditions as well as perceptions about how demand is evolving during this next little while. So we want to pay attention to the WTI futures curve, understanding what exactly it is telling us. And what it is telling us is that this is a global downturn signal because of demand as well as monetary conditions. And the fact that it's consistent with everything that we've been talking about is just, it's more corroborated. It's a very compelling signal. Like I said, it's not just a normal shift in the WTI curve. This is another piece in the wider puzzle that shows global downturn, tightening money, the last mile in the economy's evolution from forgot how to grow to remember what it is that's coming in over the next little while. To pay attention to WTI futures along with everything else. So thank you very much for joining me. Check us out, webinar later tonight, 6 p.m. Eastern time. There's a link in the description to sign up. Well worth your time to attend, and I hope to see people there. Got quite an attendance going on. Let me just finish this up. like I said, thanks for